Welcome to the Industry Experts panel at PortfolioWealthGlobal.com. My name is Michelle Holliday. Today we are welcoming one of the most popular guests within the world of economics, Dr. MARC FABER. Dr. FABER is the publisher of the Gloom, Boom, and Doom Report newsletter. He is also the director of the MARC FABER Ltd., which acts as an investment advisor and fund manager. He is also the author of several amazing books, among them The Great Money Illusion, The Confusion of Confusions, and Tomorrow's Gold, Asia's Age of Discovery. Dr. FABER is a renowned investment advisor who has been sought for many years by the mainstream media because of his economic expertise. In today's interview, we will be touching upon many key elements of investing, and everyone here is very honored and excited to have him on the show. The founder of Portfolio Wealth Global, Tom Beck, actually assisted today in formulating today's questions according to his own investment philosophy and extensive portfolio. And Dr. FABER, welcome to the show. We are so excited. How are you today?
Fine, thank you. And yourself?
Oh, great, great. This is perfect, and perfect timing with the economy, the craziness out there. Dr. FABER, we want to start off with the latest economic growth numbers. Tom believes that given the fact that the GDP growth came in at 4.1% and the CPI numbers reflect a 2.9%, investors should expect 7% from a 10-year yield bond. And until that happens, they may prefer the S&P 500 as a default position or the emerging markets. Tom doesn't feel that buyers of fixed incomes would settle for a 3%, even though it is much higher than a few years ago when the stock market was more expensive in the 2009 to 2016 era. What are your thoughts on the need for higher yields in order to draw investors to it?
Well, first of all, I don't pay that much attention to GDP, because GDP is just one measure of economic well-being. It doesn't tell you whether actually the standards of living are going up for the typical household or not. What it tells you is that the economy, as measured in monetary terms, has expanded. Now, this can happen in many ways. For instance, if I force you to consume something, say I force you to consume drugs, and to go and take health care insurance and force you to go to doctors and hospitals and so forth, then GDP expands, but it's not necessarily an improvement in your standard of living because it's forced consumption. So a lot of the consumption in the last few years has not been actually increasing standards of living. Now the 4.1% growth comes after a lengthy period of economic expansion that was very mild. In fact, since June 2009, we've been in expansion, and this may very well be the best GDP figure that we're going to see for a long time. I happen to think that the economy will slow down and not accelerate on the upside. So I doubt that interest rates will go to 7% on treasuries in the near term. Now, whether in 5 years from now or 10 years from now, treasury yields will be at 7%, or maybe 10%, or maybe 50%, who knows? That we don't know. But for now, I would essentially assume that with 3% yield on 10 years treasuries, the economy is going to slow down considerably, because you just said interest rates were much lower a few years ago. In fact, in July 2016, the 10 years yield bottomed out at 1.38%. So we've more than doubled, and I think that this is having an impact on the economy, also via the dollar strength, because a very strong dollar is a symptom of global liquidity tightening. In other words, there's less money flowing around, which is not particularly good for asset markets.
Now, sir, geopolitically speaking, turning now to President Trump and his focus upon making America great again, he has cut taxes, he is running a very large deficit, and he is renegotiating the U.S. trade agreements. There is a lot of very heated talk about this, and from your perspective, is this a good strategy? What are the advantages here, and what are the possible drawbacks or risks?
Well, in general, I'd say any tax cut is a desirable measure. But obviously, under the conditions that they are carried out and the way they're carried out, these tax cuts benefit particularly the wealthy people. And they obviously add to already a very significant deficit. So the federal deficit is going to go up. And as you know, it's not yet a problem at this point, but the national debt, the federal debt in the US, which was in the early 80s less than $1 trillion, under President Bush, it was less than $5 trillion. We're now at $20 trillion counting. And it may become a problem in future. Not to mention the unfunded liabilities. So you understand, these are not problems that are right away obvious and having an impact on the market, but they may have a huge impact in future.
Exactly. Now, sir, for investors who are looking for high-yield investments in the range of 8% to 14%, Tom has actually been finding oil and gas MLPs with tremendous balance sheets and the ability to pay large dividends. For our audience, everyone can access the free report of our top 2 high-yield MLPs at portfoliowealthglobal.com/cashflow. Dr. Farber, in your opinion, is this a viable alternative to bonds?
Yes, I mean, I think nowadays, actually even more so in foreign countries, say you go to Switzerland or to Japan. In Switzerland, the 10 years government bond has essentially zero yield. It was negative, but now it's around zero. But you can buy blue chip stocks at a dividend yield of 3 to 4%. In Japan, the same. The 10 years treasury bond is yielding 0.12%. And you can buy stocks with a 3% yield. And in Singapore, you have a government bond yield of, say, 2.5%, 3%, and you have REITs, REITs, Real Estate Investment Trust, that will yield you 5-6%. So these MLPs, if they are sound, and you have to analyze them, and I haven't analyzed all of them myself, but on the value screen that I observe, they frequently come up. So I think there is some value, and certainly it's an alternative to fixed interest investments.
Interesting. Now, as most investors know, with each passing day, the bull market gets longer and draws closer to a close. Maybe we will get a bear market afterwards, maybe a sideways market. But either way, investors need to prepare now for the possibility of years of lower multiples. Dr. Farber, in preparation for the changing times to come, what are some of your favorite bear market strategies?
Well, having a drink, having a beer is a good strategy.
There you go.
No, the thing is this. People with money, they have to realize that we had incredible asset returns over the last 30 years. I mean, when I started to invest in the 70s, the market capitalization in America as a percent of the economy was less than 30%. We're now at 150%. Treasury bonds in 1970 were yielding 7%. They went up to over 15% in 1981. So during that period of time, if you just invested, you're not smart, you just invested in government bonds, the compounding impact was huge. Now, a young guy, he goes and buys treasury bonds. In the US, the yield is relatively high, it's 3%. In Europe, it's 1.5%, sometimes 0%. So here in the US, you still get the yield, but you're not going to get rich on 3% per annum. You understand? Right. The compounding impact, you have to live a very long time. So I'd say in general, if your target is to earn 8% per annum, in my view, you have to take huge risks. I think going forward, because you see, many people misunderstand. Inflation manifests itself in many different ways. You can have inflation in wages. It didn't happen in the US. You can have inflation in commodities. It only happened to some extent in the US in terms, say, oil prices have rebounded and so forth. But in general, commodity prices are not that much higher than they were in the 70s. But the thing that has gone through the roof are financial assets, stocks, bonds, collectibles, like vintage cars and old posters and art. I mean, when I grew up in the 50s and 60s, a painting that would cost $1 million was unheard of. These were museum pieces. And now you have paintings that sell for 500 million. I mean, this is amazing. It's like when I grew up, a soccer player or football player, he hardly made any money. Now the transfer fees are 200 million and so forth. So, we had this huge inflation in selected parts of the economy. These parts, they led to growing wealth inequality. We have the rich people, and luckily I have assets, but then we have still a lot of people in this world that have very little, and they have actually no chance to get into this upper class. So I think the returns from now on for the rich people, and this is something I'm concerned with every day, I think we're lucky if one day we'll have about half as much as we have today. I think we'll lose a lot of our assets, yes, because the valuations are very high. And I can tell you, you can just open any real estate book, high-end properties in the US as an example. I know lots of high-end properties that were on sale for 50 million, and nobody wants them because young people, they can't afford them, or they don't want to live that lifestyle. They prefer to live in a condo with a key like you, and then you open the condo and you close it and you have no headache.
Right. A lot simpler.
You understand? So my friends, for instance, there's the issue in California is less pronounced. A friend of mine, he has a big property in New Hampshire. The tax on his property is close to $500,000 US a year.
Wow.
It's a very expensive carrying cost. Property is very big. He needs 10 employees to do the garden and to keep the houses in good order and the cook and so forth and so on. So these kind of properties, not many people want to live, because New Hampshire, more than half the year, you can't even get into your house because you need to be a snowman.
Right. Exactly. And it's a full-time job to take care of it.
Full-time job. I have a large property here in the north of Thailand. And okay, here it's maybe a bit easier to have employees, but it's not so easy to find honest ones and reliable ones. Not people that say, oh, my mother is sick and I have to go home now, and so forth and so on. But alone, I would not be able to maintain the houses we have. Impossible.
Right. Now, sir, turning now to fiat currencies, is there an alternative at this point in time to the current USD system?
Yes, I mean, we had many so-called reserve currencies. We had, at the time of the Romans, around the time of Jesus Christ's birth, we had the Roman dinar or aureus, and these currencies were in general accepted around the world. I mean, in that time, the world was the Mediterranean and the Middle East.
Yes.
And then we had currencies under the Spaniards that were also accepted around the world. That were gold-based coins and so forth. And then we had essentially the British pound. That was the world reserves currency until after the First World War. And then the US dollar. And the US dollar has been a reserve currency and the fiat currency, as are other currencies. And in my view, eventually they'll end. You understand? They'll be replaced by other currencies and maybe other forms of keeping money. Maybe something like a blockchain kind of cryptocurrency. Who knows?
Right.
But obviously the days of the US dollar are numbered, and I think the trade war is not going to help or not be helpful for the US in the long run. I'm not saying that the trading system nowadays is entirely fair, but it's not as crystal clear to the disadvantage of the US, because you have to see one thing. The US has a trade deficit. Okay. There are many reasons for it, but it's not just that because China has stolen all the secrets from the US and so forth,
right.
And because they cheat and so forth. That is an oversimplification. But number two, when you just think about it, here you have Asia, not just the Chinese and the Mexicans. They work in hard labor in factories and in small shops and so forth. They produce goods and then they sell them to the US, okay? Say a Nike shoe they sell for $10. Then Nike pushes the price up and sells it to the wholesaler, say, for $30. The wholesaler sells it to the shop for $60. And the shop sells it to you for $180.
Right.
So who's making actually a big profit? China or you? Or, I mean, the US. Number two, if the Chinese have a trade surplus, and they have a trade surplus of something like $400 billion with the US, then the money comes to China, okay? It accumulates in their reserves, and then these reserves flow back to the US, and they buy treasury bonds, treasury bills, US stocks, US corporations, US real estate. Without the Chinese peers in California, the real estate would collapse.
Wow.
You understand? So this relationship, the US sends to China paper with a dollar sign on it. What is worth more, the Nike shoes that are made in China or a banknote that is printed by the Fed? You tell me.
Yeah, I do.
I think actually the whole trade issue, the US has had a huge advantage, in my opinion.
Interesting. Now, sir, gold prices have gone down this year, as well as silver prices, while
Yes.
oil prices have more than doubled in recent years. With energy being the most determining component of gold mining expense, why has the gold price not risen also? What are the determining factors that create the demand price for gold and silver?
Yeah, this is a good question, and it is frequently misunderstood by investors who look at the cost of producing gold and they look at the supply of mines in 1 year and the demand of gold in 1 year. You see, the gold is a different commodity from and wheat, corn, soybeans, sugar, and so forth, in the sense that every ounce of gold that has been produced for the last 5,000 years, since the times of Babylon and King Solomon, still exists. It hasn't vanished, you understand?
Right. Mm-hmm.
Whereas if you drink a Starbucks coffee, once you drank your coffee, that coffee has vanished into your stomach.
Right.
And so this is a big difference. The price of gold is determined by jewelry demand, industrial demand, but principally by the psychology of people. If they feel insecure about whatever it is, they may buy gold. Now, what happened in the last 2 years, to some extent, is certainly this year the dollar has been strong. And number two, cryptocurrencies came up. So a lot of people that normally would buy gold, they speculate in cryptos.
Right. Blockchain.
So the price of gold and platinum and silver has gone down. It's still higher than in December 2015 and still much higher than it was in 1999. Mm-hmm. So over a long period of time, it was actually quite a good investment. And I'm not suggesting to you or to anyone to put all his money into gold. But when you think about it, what is a hedge? We live in a time of great financial instability.
Right.
You know, we have a financial bubble in the world that is much bigger than the real economy. And so if you want to hedge and you talk to me about what should people do if you assume that at some point there is a bear market, well, I assume there will be a bear market still in my lifetime. It's not that long anymore, but it's still in my lifetime. So I want to at least hold some gold. And for that insurance policy, I'm not saying it will go up, but when everything will be bad one day, if I have a bar of gold and so forth, it will have some value, you understand? Mm-hmm. And I can sell it at the gold shop or somewhere and liquidate it. I'm not sure how much stocks and bonds will be worth one day.
Right. It's a safety valve. Now, sir, while we're on the topic of gold, we want to briefly mention to our audience that everyone can get a free copy of the world's most extensive gold investment report at portfoliowealthglobal.com/gold playbook. Dr. Farber, we have seen many quote-unquote gurus talking about $5,000 gold, $10,000 gold, even $50,000 gold. Is this a possible scenario, or has the 2008 scare been largely avoided to enable the current debt bubble that you were just speaking of to continue for another 10 to 20 years without any severe ramifications?
Well, again, this is a very good question, and it's not, say, easy to answer it in just 2 minutes. But basically, we have this credit bubble. You know, when I look at how much credit at the end of the 1970s, the total amount of credit in bonds globally was less than $1 trillion. Today we're at something like $180 trillion. So we had this huge. I mean, it was a bond issue in those days in the 70s. A large bond issue was 50 million to 75 million. Nowadays, $1 billion is regular. Sometimes countries are issuing $5 billion worth of bonds in one go. The deficit in the US is over $1 trillion annually. I mean, these are unheard figures. And if you had told someone in the 70s, when the Dow Jones fluctuated between, say, 500 and 1,000, that the Dow would go over 20,000, he would have said, "You are cuckoo. You are nuts. You are nuts." So we had this huge financial inflation, and it is entirely possible that it continues. You know, the Dow could essentially go to 200,000, 2 million. Depends on how much money you print. But in real terms, it may not go up. It's like if you look at, say, the high inflation period in Latin America in the 1980s, the stock markets of Mexico, Brazil, Argentina, they went all ballistic in local currency, but the currency collapsed. And so in real terms, in dollar terms at that time, these markets didn't go up, they went down. So you could have essentially a period of time where stocks go actually up, but they go down if you measure them in gold. You know, you can measure the Dow Jones against gold or the S&P against gold or against Bitcoin. So we don't know all these things. We know that the markets are manipulated, maybe not purposely, but probably purposely by central banks that print money and keep interest rates artificially low.
Dr. Faber, yeah, we hear that all over, the manipulation, not just in money, but in precious metals, just all across the board. Now, in your opinion, from your point of view, is the United States still the best place to do business?
Not in my opinion. I mean, I was born in Switzerland. I grew up in Europe. I went to New York in 1970, worked on Wall Street, and then in 73 I moved to Asia, and I've lived in Asia ever since. And one of the reasons, I'm not saying it's the only reason, but one of the reasons was that I saw that Asia would have a huge growth potential, and that there would be a huge creation of wealth in Asia, which obviously when you're involved in finance is good.
Oh, yeah.
You know, when you look at how poor Asia was in 1970 and how wealthy some countries have become, like Singapore, Hong Kong, South Korea, Taiwan, Japan, and so forth, then you have to say this is unbelievable. And if you look at progress and the development of infrastructure, just today I read an article about New York, about the city that is going down the drain because the infrastructure is not there. And we have still in Asia what I would call relatively pure capitalism. You know, we have much less social institutions than we have in the West.
Now, Dr. Faber...
So I think I wouldn't want to live in the U.S., but some people want to live in the U.S. And for me, the taxation in the U.S. would be much too high.
So there's no state or city in the U.S. right now that you feel would be attractive?
Well, I mean, I tell you, I like the Midwest and I like the South. You know, states like Kentucky or Tennessee or so. But yes, I prefer to live in Thailand. And if I didn't live in Thailand, I mean, I still have an office in Hong Kong. I think Hong Kong is a very livable city, or Singapore, or I could live in the Philippines or in Indonesia. I happen to think that in the north of Thailand, the climate is reasonably good. And my daughter, she lives in Laos, which is adjacent to Thailand, and she likes it there. She also, I mean, she was brought up in Switzerland, but she's half Asian. So I think And I have also some property in Vietnam. I could also live in Vietnam.
Now, sir, going back to investing, for investors with a small portfolio, $10,000 to $20,000, should they simply buy an index fund, or are there any incredible opportunities today as there were in 2017, such as cryptocurrencies? You know, Tom writes our newsletter, and he was one of the first to mention Ethereum at $15 and Litecoin at $17, and our subscribers were able to make a lot of money. The list for our new top 5 altcoins for 2018 for our listeners is at portfoliowealthglobal.com/top5. That's TOP and the number 5. Dr. Farber, going beyond the cryptocurrency ecosystem, do you see any market inefficiencies which now offer triple-digit returns with any class right now, any assets?
Well, I think they are all the time triple-digit return opportunities in options and stuff like this. But you understand, you also go up the risk curve. In other words, if you have the potential to triple your money, I suppose the risk is fairly high. And it depends on your financial condition and your salary and your position in life. I mean, I don't need to treble my wealth. What I need is not to lose everything. You understand?
Right. Exactly.
So, we have different objectives. Now, if you're young and you have a secure job and you have $20,000 and you want to roll the dice, I'm not sure what is better, to go to Las Vegas or to Macau or to buy some of these investments that can yield these very high returns. But I'm sure there are still opportunities with investments that will provide you high returns. I'm talking, generally speaking, that assets, you see, when I started to work, salaries were high relative to assets. In other words, I got a salary, and with that, I could buy the Dow Jones. I would have had to work 25 hours to buy the Dow Jones. Now I have to work on 150 hours to buy a Dow Jones. So in other words, at the time in the 70s, salaries were high and assets low. Wow. Same for real estate. Now, as you know, and this is a social issue, a lot of millennials, they earn inflation adjusted, most of them, they earn less than their parents. And with 35, they have less money than their parents, we the boomers. And for them to buy a house is practically out of the question.
Yeah.
They can stay with someone, they may, they stay with someone, they share a house or share an apartment, 4 people in the same apartment. One sleeps during the day, the other one in the evening, and so forth. Maybe it's a fun life, I don't know. So this is a different lifestyle. And but in general, asset prices, the Dow, the S&P at this level, S&P 2,800, is relatively high. The bond at a yield of 3% is not a disastrous investment, in my opinion, but it's not going to make you rich. And if you buy a condo somewhere, and you're probably sitting somewhere in Los Angeles, as you know, Los Angeles has very high condo prices at the present time. And if you go a bit south of Los Angeles to, say, Newport Beach, Huntington Beach, Long Beach, it's very expensive. These are pricey property markets, like along with San Francisco and Seattle. So for young people to buy that, he has to then take a large mortgage, and it becomes an expensive proposition. I mean, I've been on Manhattan Beach and so forth, and Newport Beach, small houses on the beach. I mean, these are not fancy Beverly Hills mansions. They cost $2, $3, $5 million. Unbelievable.
It's outrageous. Now, lastly, sir, what is the significance of dividends in investments?
Well, this is now for investors, and I'm not talking here about speculators. It's a very interesting aspect. Dividends and compound annual returns. Do you understand? If you invest your money, $1 at 5% compound, after 100 years, you will have over $100. Do you understand? Mm-hmm. So 5% compound yield is like this famous example of the man who invented the chessboard. He said to the emperor, I just want to have one rice corn on the first field and two on the next field. You know, the compounding interest is incredible in the long run. And nobody has ever made 5% per annum over like 1,000 years. That doesn't exist. Wealth has been continuously destroyed by wars and currency reforms and so forth. But dividends, of course, they help you increasing the compound return. So if you have a stock portfolio and the overall stock portfolio yields 2%, dividend yield 2%, it will take you longer to make money than if the dividend yield is, say, around 5%. And the beauty of dividend yields is, of course, dividends can be cut, and occasionally they are being cut. But in a downturn, frequently the stock will go down, but the dividend will not be cut. And so as the stock price goes down, you get the dividend and you can buy more shares, but at a lower price. This is essentially what you want as an investor, is to buy with the same amount of money as much stock as you can. Yes. So I'm in favor of essentially buying stocks with a high dividend, yes. I think for most people in life, the most important strategy is not to lose any money, because people, through greed and through all kinds of crazy ideas which they hear at cocktail parties or from friends and so forth, they always buy stuff and then they lose a ton of money. And to lose 50% of your money, in order to make it back, you will have to make 100%. You understand? A loss is a loss. To make it back is not so easy.
Right. So
it's
stay away
the
from
same. If you lose your boyfriend, to find a new one is maybe not so easy.
Exactly. Dr. Farber, this has been an amazing interview. Thank you so much for coming on this show. Please tell us all about your Gloom, Boom, and Doom report, as well as your books and how everyone can follow your work.
Well, basically, I have two reports. One is the Gloom, Boom, and Doom report. It goes out by mail. It's a written report. It's mostly essentially for wealthy people and for financial institutions, because it's not, to buy this stock today and sell that one tomorrow. Oh. Then I have a website report that is more market timing related, whereby I don't know any market timer who is always right. But anyway, that is a more timely letter. That is a website report that you can subscribe under gloomboomdoom.com. And the book is now a little bit out of order because I wrote the last one in 2001, which was, the title was Tomorrow's Gold, Asia's Age of Discovery. But it was basically, the theme was that the rise of China as an economic power would drive up the demand for commodities, And it would also lead to, and as a result, drive up the demand for commodities and also the prices of commodities. And that it would lead to new geopolitical realignments that say Asia and the whole world, which was very America-centric, would become much more China-centric. And today China has larger trading relationships than the US. China has trading relationships that are larger than the US with 124 different countries. So in Asia, when I arrived in Asia in 1973, people used to say, well, when the US sneezes, Asia catches a cold because all the exports went to the US. Nowadays, all the countries have larger exports to China than to the US, all of them. The last one was Vietnam. That now has also been overtaken by China. So geopolitically, they're now much more tied into the Chinese sphere of influence.
Wow.
And you can see it. I mean, I travel a lot. I live here in the north of Thailand. 30% of tourists in Thailand are from China. You take the Chinese tourists away, the whole hotel industry collapses. Yes, same in Vietnam, same in the casinos, everywhere. The Chinese, they have 140 million Chinese traveling outside China every year. 140 million.
That's amazing.
Amazing, you know. But it's amazing because in the year 2000, that's not that far back. There were only 10 million, and in 1985, only 1 million. You have to see up the growth.
Wow.
Yes.
Now, what do you attribute to that tremendous growth in comparison to?
The thing is, this country had been kept down under communism, and they started from a low level. But the Chinese are very hard-working people, and they had a high propensity to save. And when they save, and then they travel, and they save, and they invest, and they save and gamble, and so on. But it's a very hard-working country. It may change over time. But, you know, in this whole trade war, you also have to consider who is more able to withstand hardship. You understand? The Russians and the Chinese, prosperity is an unusual state in their history.
Wow.
So they are used to hardship. So to go back to hardship is maybe easier for them than for us in the Western world.
Oh my, isn't that the truth? We're not used to it.
So these are all things that one has to consider when making judgments about who will have more damage if there is a trade war. Yeah, I think China will have damage, but I can tell you, so far, the tariffs have actually been bad for the US. Steel prices have gone up a lot. Soybeans are not being sold. Now they have to bail out the farmers, and so forth and so on.
Wow.
So it's not clear-cut, we will win and they will lose. Every war, both lose, some less than others.
Yes. Sir, this has been fascinating. Thank you so much for taking the time to come on the show today.
You're welcome. Bye.
Goodbye. Dr. Marc Faber, investment advisor, fund manager, author, and the publisher of the Gloom, Boom, Doom Report. For the Industry Experts Panel, I'm Michelle Holliday at PortfolioWealthGlobal.com.